Soft Currency Economics by Warren Mosler. The Discount Window, History and Operation. The role of the discount window changed considerably between the founding of the Federal Reserve in 1913 and the 1930s as open market operations gradually replaced discount window borrowing as the primary source of Federal Reserve credit. Then between 1934 and 1950, the discount window fell into disuse. Since the creation of the Fed, Regulation A has set the procedures that banks must follow to gain access to the discount window. Reserve banks may lend to depository institutions either through advances secured by U.S. government securities or by discounting paper of acceptable quality such as mortgage notes, local government securities, and commercial paper. The rate on the loans from Federal Reserve banks to depository institutions is set administratively by the Fed. The Board of Governors initiates a discount rate, and the 12 regional Federal Reserve banks adopt it within a 2-week period. Although we speak of the discount rate, there are actually several rates, depending on the collateral offered by the borrower. Each Federal Reserve Bank's Board of Directors sets its discount rates subject to approval by the Board of Governors. Since the 1950s, the Fed's stated policy encourages persistent reliance on borrowing. Borrowing from the discount window is supposed to represent only a modest share of total reserves. The actual amount of borrowed reserves is total reserves demanded by the banking system minus the amount of unborrowed reserves provided by the Fed through open market operations. Officially, the Fed fashions the discount window as a safety valve, a temporary source of resources when they are not readily available from other sources. The discount window is simply a means of accommodating the reserve requirements of the banking system, the same reserves provided through open market operations, but with a slightly different price and slightly different packaging. Both the 1980 and 1990 versions of Regulation A state as a general requirement that Federal Reserve credit is not a substitute for capital. But all along, Fed policy has determined the amount of borrowing. To the extent that immediate reserve needs are not provided through the open market purchases, they must be provided through the discount window. In this context, the window's role is in meeting known reserve needs. Throughout its history, the Fed has used the discount window for much more than its stated purpose. To accommodate Treasury financing needs in World War I, the reserve banks were empowered to extend direct collateral loans to member banks. Continuous borrowing year in and year out was not uncommon in the 1920s. The availability of the discount window was expanded in 1932 by the Emergency Relief and Construction Act. The act opened the discount window to non-banks. It permitted the reserve banks to lend to individuals, partnerships, and corporations with no other sources of funds or notes eligible for discount at member banks. The Act of June 19, 1934 authorized reserve banks to make advances to established commercial or industrial enterprises for the purpose of supplying working capital if the borrower was unable to attain assistance from the usual sources. It is unclear whether the act had any impact on the net amount of lending. Essentially, Federal Reserve banks were authorized to make loans on behalf of the taxpayers. When a Federal Reserve Bank made a direct business loan, the loan created a new deposit in the banking system. The new deposit added bank reserves, which could be used to purchase government bonds from the Fed. The net change to the banking system's balance sheet was an increase in deposits matched by an increase in government securities. Reserve banks continued to make and co-finance working capital industrial loans until authorization to do so was repealed by the Small Business Investment Act of 1958. Since the 1980s, Federal Reserve lending to institutions with a high probability of insolvency in the near term represents a major departure from its historic mandate to provide loans to illiquid but not insolvent banks. A study conducted at the request of the House Banking Committee collected data on all depository institutions that borrowed funds from the discount window from January 1st, 1985 through May 10th, 1991. Regulators grade banks on their performance according to a scale of 1 to 5. The grades are based on 5 measures known by the acronym CAMEL for capital, adequacy, asset quality, management, earnings, liquidity. The Federal Reserve reported that of 530 borrowers that failed within 3 years of the onset of their borrowings, 437 were classified as most problem-ridden with a CAMEL ratio rating of 5, the poorest rating. 51 borrowers had the next lowest rating, CAMEL 4. At the time of failure, 60% of the borrowers had outstanding discount window loans. These loans were granted almost daily to institutions with a high probability of insolvency. The Fed's use of the discount window has expanded to cover a wide range of reserve needs. The frequency of borrowing from the discount window has no explicit restrictions. The banks using the discount window are not held to any financial strength standards. The de facto criterion for eligibility for discount loans is simply need. Experience has consistently shown that the Fed will not allow a bank to fail when a bank requires a loan to cover its reserve requirement. The cost of discount borrowing may vary considerably as the discount rate changes and as administrative costs and/or penalties change. Nevertheless, the discount window remains accessible to any bank's reserve needs. The Fed's allocation of borrowed reserves as a percent of total reserves has been less than 1% since 1986. Since 1950, borrowed reserves have fluctuated from near zero to as high as 6.5% of total reserves. The bank failures during the mid-80s heightened the public's awareness of discount window borrowing as a sign, accurate or not, of fiscal weakness. Banks have become more hesitant to go to the window so as not to damage their reputation.